Vetri Subramaniam, Chief Investment Officer with Religare Invesco Mutual Funds, joins us live from his Mumbai office. Vetri, good to have you back on ET Now. It's been a while. Vetri, these are clearly dark days for Indian markets. Now, it's easy to make a bearish argument, but in this kind of an adversity, where is the opportunity? What is the silver lining in this dark cloud?
Actually, it's even darker days for the economy than it is darker days for the market. If you actually look at it, the market is down only 4 or 5%. And yes, certainly there's a lot of divergence within the marketplace. Some stocks have almost, collapsed 50-60% year to date, and there are others which are sharp gainers. But actually, I think the pain is now fairly widespread within the economy. So in that sense, there is very little bit which is visible in terms of a silver lining, except to say that in the economy sensitive areas, I think valuations have now corrected very significantly, but sometimes that by itself is not enough to really get equity markets moving for two simple reasons, which is that first of all, there's no sign of any improvement in economic momentum or an earnings growth trajectory for the economy sensitive companies, and secondly, I think right now the focus of policymakers appears to have shifted to sort of stabilizing the currency, as they call it, but the net effect of that is actually that you are dampening growth rates further. So I think in that sense it is a little bit of an adverse environment, and the best that one can do right now is look at the companies where valuations are reasonable, but that's not necessarily a guarantee that you will see performance in the near term.
Vetri, that's the point, right? Because the negative news flow on the economic front as well as the currency and all of it has been much deeper than what the market has already showcased. I mean, we've just fallen 3 to 4%. How much more downside to go after 10 days of pain that we've seen, in the last few trading sessions?
Yeah, I know when you put it in the context of 10 days of pain, I don't think that's, the right context at all. But I think, from a valuation perspective, there are two ways to cut this. One is that we are trading slightly cheaper than average, so, valuations are not really blinking red in the sense of being expensive. But again, I think the worry over there is that we are now headed into a third year where earnings growth may actually be in single-digit numbers. And can you then expect valuations to continue to trade only marginally cheaper than long-term average when earnings growth for the third year in a row is likely to be in single digits? I think that's a bit of a question mark. We've said this before, but if you look at trough valuations for India, they are still 15-20% lower than where the market currently is. There is no guarantee that the markets will go there. It's impossible to predict when it will go there, if at all it will go there. But I think that's just useful to know that you certainly aren't trading near trough valuations. So if you're looking for a cheap bargain basement opportunity in terms of valuations relative to the fact that growth in the economy has come to almost a virtual standstill, then we are not there as yet. But again, as I said, there's no way to guarantee when and how it will actually get to that point.
Vetri, you're so right. Just because valuations are approaching historical lows, that does not mean that stock prices will not hang in. Their economy has to bottom out for some of these stock prices to recover. So Vetri, let's look at how the trajectory of market this year. First, infra stocks, they led the decline. Then bank stocks, they got hit. Do you think the next leg of decline will largely be dictated and dominated by consumer names and quality stocks? The force with which HUL, ITC, HDFC, Asian Paints, HDFC Bank, they've fallen in the last 4 or 5 days. That's quite scary, and some would say that's also alarming.
Yeah, I think let's just follow the thought process through on the economy. We've clearly seen the economy slow down dramatically, and that's getting reflected in a lot of companies and businesses. But I think the worry now is that it is, starting to spread across the board. The consumption story, so to speak, which was talked about a lot in recent years, is also now clearly showing signs of flagging, and that is understandable because when you look at the data, you've got, for example, one of our biggest job-creating engines in recent times, the IT industry, talking about adding less people this year than it did last year. And, we've already seen several companies in the auto sector as well as in the other manufacturing sector talk about actually laying off people, shutting down their factories for a few days. So in a sense, it signals that this is not the best of time for job additions within the economy. If anything, we may actually be, losing jobs within the entire economy. In that kind of a scenario, it is certainly not good for consumption spending trends. It's also not good for the health of credit at some point of time. So I think we are going from a isolated problem to something which is getting a little bit more generalized, and this is certainly a cause for concern at this point of time, because we're still not able to see a clear sort of route out of the current tough economic environment. So in an investing scenario, the only call that we can take as of now is not so much to forecast when things will improve, but to try and focus our efforts on identifying those companies which are able to bide through these challenging times and will hopefully be in a much stronger situation as and when the economy improves. We're not really here to take a call on when that economy will improve, because my visibility is as poor as anybody else's, and corporate India's visibility is also very poor. So all that we can bet on at this point of time is which are the companies that will eventually come out of this reasonably unscathed and on a strong wicket to benefit from growth as and when it happens, but we don't know when it will happen.
So Vetri, would that sector be IT? Will it continue to show resilience and sort of wade through this dark patch?
In some senses, yes, and I think it goes back to the fact that the currency in India has now, fallen quite significantly over the last 2 years. And if you look at it, eventually this currency benefit will help companies who are significantly competitive, globally competitive exporters, so to speak. And when you look at the Indian market landscape or the economic landscape and ask yourself which are those companies or sectors where we have produced companies which are globally competitive, then clearly IT stands out. Pharma also has a few standout candidates. So I think in general, exporters as a theme is something that the market is likely to continue to favor, because this is a fundamental, rearrangement of our exchange rate and our terms of trade. So, any company in any line of business, not just IT, if it is a competent exporter, is on a slightly strong wicket over the next few, years.
And Vetri, at a time when there are too many opinions which are floating around on when the economy will recover, how the economy will recover, how are you really structuring your portfolio which will benefit from an economic recovery?
Yeah. As I said earlier, Nikunj, I don't think anybody really at this time has any visibility whatsoever on when we can hope to see any sort of recovery in economic momentum and growth. None of the lead indicators are pointing that way. So really, as investors, our option at this point of time, or our strategy at this point of time, is largely to make sure that we are focused on those companies where we think fundamentally their business models are sound, they've got decent return on capital even in the current challenging economic environment, they've got reasonable cash flow, and the balance sheet is not under any degree of stress whatsoever. I think these are pretty much the most important criterion at this point of time, because this is what will ensure that the company is still around at the point in time where the economy sees a recovery. So in that sense, all we are doing now is betting on what we think are among the best placed companies to weather the current storm, rather than predicting when the current storm will lift and when the economic environment will improve. So that's really the strategy from a fund management side perspective at this point. I think the only additional point that I would make, and that's something that you've been alluding to earlier as well, is that there is obviously a fairly sharp dichotomy in valuations at this point of time. Not just between what you would call the sort of non-cyclical components of the market and the cyclical components of the market, but also within individual sectors. There's a very big difference in valuations between companies that have sort of quality, high quality, variables, and those that are exhibiting much lower quality financial stability variables. So that is something that we are, acutely aware of, and trying to balance out the portfolios between these two, because certainly without doubt, if you pay a very high price in terms of valuations just because of near-time stability in earnings, it may not necessarily yield you returns over the longer term, because stocks do tend to move around in terms of valuation cycles, and you could catch the wrong end of that valuation cycle move. So the policy also in terms of sector allocation is really to sort of actually look at it more at a stock level and balance out the portfolio across sectors, across companies, rather than try to get concentrated in any one component of the market at this point of time. So really in that sense, it's a balanced approach rather than trying to get acutely biased towards any one section of the market.
That brings me then to my next question, Vetri. Do you think the strategy should be adopted when it comes to the pharma space? Because now it seems like Ranbaxy may have bottomed out, the earnings have been half decent, and you are seeing on the other hand Sun Pharma and Lupin disappoint when it comes to their earnings. So Is it time now to sort of change the portfolio stance when it comes to pharma individually?
I can't comment on specific stocks, but I think as far as the sector is concerned, as I said earlier, this is one of the sectors in which we have a lot of companies which have proved to be globally competitive. They've proven themselves in terms of their ability to compete in global markets across, whether it is in the US market or in generic markets in the developed economies elsewhere. So this is a sector where we think, companies are well placed and they will enjoy the benefit of currency depreciation. So it's an area where we would stay sort of positive on a bottom-up basis. And in any case, in the pharmaceutical sector, I think it's always been the case that you need to be a lot more bottom-up because the companies tend to be driven, very specifically by their own, in this instance, regulatory issues, and also in some cases by their own, R&D and product pipeline and generic product pipeline. So I think in pharmaceutical, it's always been the case that you need to be bottom-up even more than some of the other sectors in the marketplace.
Vetri, the way markets always move is that they always tend to discount future well in the present. So how does one figure out that at the current juncture, all the bad news is in the price or it is still not in the price?
You really have, no clear way, or nobody rings a bell and tells you that this is indeed the case. So it's always got to be a fine judgment. And I think in that sense, again, I would go back to the other issue, which is that what's more important in that sense is the survivability of the company and its historical track record of its ability to earn a reasonable return on capital, and the fact that it has not compromised itself in terms of running an excessively large debt load at the current point in time. If you've been able to find those two factors, then I think this is an environment in which we are willing to sort of take a little bit of risk in some of these companies, not because we perceive risk to the business model, but because we perceive risk to earnings. But that's an acceptable risk to us at this point of time, because over the medium to longer term, this is where we think that the eventual upside will come through whenever the economy recovers. So it's a very fine balancing act. You can never be sure that you've got it perfectly right, but it's what we try to do all the time. And I think, at least so far this year, we've been reasonably happy with the results that the alpha has been coming through. But I think, the question on most investors' mind is when will the overall returns come through and not just the alpha creation. And to that, I think it's still a little bit of a challenge because we're not really able to see the overall market returns picture improve very dramatically, but we are reasonably more confident that we can add some alpha.
Vetri, what about banks? Is it time to start bottom fishing, or do you think there is still a whole lot of pain left in the sector?
I think as far as banks are concerned, there are still two issues. One is that I think a lot of the large corporate sector, infrastructure, large project-related lending which has happened, I think a lot of that is still set to come up for restructuring. So I think that is going to be a pain point for a lot of the banks. The second issue is that while, most of our conversations with banks indicate that their retail lending portfolios are holding up very well in terms of quality of credit and the NPA trends, I'm a bit wary over there, maybe a little bit early. But we are getting a little bit wary and starting to explore this a little bit more in detail, because eventually if the job creation engine has come to a halt and you're talking about job losses selectively in some sectors, then you have to worry about, the likelihood of NPAs rising in the retail book as well. And the second point, as far as the retail book is concerned, is that interestingly, all the banks and the NBFCs still tell us that retail advances are growing at 20 to 30% for all of them. And, my worry over here is what are people actually doing with that money? Because I'm not seeing that money getting spent in consumption trends. None of the companies are seeing that kind of momentum on their revenue growth. Maybe this is increased penetration of the lending product across the, length and breadth of this country. But I'm just saying that the answers are not known, and therefore we have to be a little bit more wary that NPAs could rise even in areas like corporate lending, project lending, and also in retail lending at some point of time.
You have a large exposure to private banks. After the recent RBI action, do you think the safe haven status of private banks is now getting challenged?
I think the RBI action affects all banks, so there's no doubt about that. But our, premise in buying banks has always been that, banks are, the best banks are always the ones which have a very strong liability franchise. So largely we have tended to only back those banks which have a large liability franchise. To the extent that RBI has tightened, it will hurt all banks, but the ones which have a strong liability franchise will hurt less. So I think that thought process has not changed much for us, and we'll continue to prefer the banks which have a strong liability franchise, because that is truly their long-term competitive advantage. The cyclical issues they will have to go through just like anybody else. But we certainly again have some comfort in some of these private names, because they've exhibited now over 5, 10, 15, 20 years that they've been able to handle the credit quality cycles quite well, whereas some other banks have not done it so well. So I think largely we've concentrated again over there more on a bottom-up basis on the banks where we have comfort on strong liability franchise, and secondly on their past demonstrated track record in terms of what's happened during various credit cycles.
Very good chatting with you. Really appreciate you taking the time out and joining us today.